How much do you need for a down payment on a home? $1 million. Okay. No, you don't need $1 million. We will talk about how much you actually need. And that was a terrible Dr. Evil impersonation, if we can even call it that. It was my best try. Before we get into it, if you would subscribe to our email list, these videos will be sent directly to your inbox as soon as they're available. We will not spam you because spammers suck, so please do so. The link is below. Now, how much do you really need for a down payment on a home? I'll tell you, it's not $1 million. Every buyer is different. Everybody's financial situation is different. Everybody comes to the table with a different set of experiences, different job, and we can work with pretty much everything. And there are options for pretty much every buyer that's out there. Now, somewhere back in time, I have no idea when or where or how, 20% became the gold standard to obtain a home mortgage. It just became the norm. It was what was expected sort of back in the day. And even now, it just is the norm of what people are expecting to put down or what they think they need to put down. I think there's some group of bankers that probably got together way back in the 20s and said, what should we have for a down payment? Oh, 20% sounds good. Okay, so now everybody for the next 100 years feels like they need to put 20% down. So that is one of the gold standards. It is a level that is nice to get to because if you put 20% down or more, you can avoid what is called private mortgage insurance. A bank or the investor actually who will ultimately buy your mortgage looks at risk, and they create this table and say the more money somebody has, the less risky they are to loan money to. And for people that have less money, those lenders and those investors would say, okay, that person is more risky on our table, on our chart, on our risk meter. Those people are more risky to loan money to because they have less, and we say that they're less likely to pay us back in the end. Whether that's true or not, doesn't matter. That's what their risk chart says. Now, for anyone less than 20%, they make you pay a little bit more for that insurance premium that covers them in the event that you may default on the loan. So anything under 20%, you have to pay insurance, mortgage insurance. Anything above 20%, you don't have to pay that. So that's why it still is kind of that standard. If you can get to it, that's great. Now, forget 20% for a bit. Let's just say you don't even have it. Banks can pretty much work with anything from 5% all the way on up to 20%. You can get a great loan, a normal loan, 30-year term, and that's the other thing, 30 years. Who came up with 30 years as the norm for a loan? I don't know. Someone way back in that banker circle decided 30 was a great number. You can do a 10% down loan on a 15-year term or whatever you want. But most people are trying to buy the most house they possibly can, and so the 30-year term usually allows you to do that. Now, for anyone that has less than 5%, you can get what's called an FHA loan. FHA stands for Federal Housing Authority, and it's a truly government-backed loan. Without getting into all the details, it allows for a lower down payment, 3.5%. It allows for a little bit lower credit score and a little bit other less than perfect marks on your financial history. And it can be a good option if all you have is 3.5%. It can be a great idea to obtain that type of loan in order to buy your house. Now, if you're opting between a 3.5% FHA loan and a 5% conventional loan, typically you're going to get better rates, better terms, and just a better overall financial picture with that 5% loan. It's a little bit less expensive than it is to obtain the 3.5% FHA loan. Now, if you're a veteran, thank you, first of all, for your service. You have at your disposal what's called a VA loan. Now, the main benefit of a VA loan is you can do 0% down. There's very favorable terms, and it's pretty much just a done deal once you're qualified for that VA loan that you can purchase with 0% down. There are some other fees that aren't associated with a more conventional loan, but they're pretty minimal. And sometimes sellers even have to pay those for you. So there you go. We can go from as low as 0% all the way up to $1 million if you have it. But 20% is always that gold standard to avoid mortgage insurance. As long as you have anywhere between 3.5% to all the way up to 20%, you probably can qualify for a loan, assuming that you've got a job, you have decent credit, and your debt to income ratio isn't completely out of whack. Debt to income ratio must be another video because we don't have time for that now. Thank you for watching. We will see you on the next one.